Good morning or good afternoon, depending on where you're joining us from. Welcome to today's webinar, which is going to be an Unemployment 101 training. My name is Nicole Korn, and I'm the Director of our Unemployment Insurance Solutions here at 501c Services. A couple of housekeeping items before we get started. There is a copy of today's presentation located in the handout section of the webinar toolbar. So if you'd like to have a copy of the presentation, feel free to go there and download that. Also, I am planning to keep everybody on mute just to avoid any background noise or distractions. But if you have a question, feel free to type that into the questions chat box. I'm going to try my best to leave some time at the end of today's webinar to go through some of those questions. However, there are a lot of individuals attending today. And so if I don't get to your question live, I will follow up with you directly after the webinar. I should have your email address, and I assure you I will get back to you with any questions that you might have. Also, if you are joining today for the continuing HR credits, such as SHRM or the HRCI credits, in order to get the code for that, all you have to do is fill out the survey that you will receive after today's webinar. And once you fill out that survey, within 24 hours, they'll send you the code for your SHRM and HRCI credits. Okay, so let's go through the agenda real quick. First, we're going to start with a brief history of unemployment and how it got started to give you sort of what the foundations of the program are. Then we're going to move on to chargeability and liability. Then we'll talk about the different types of separations as well as some adjudication strategies. And we'll finish up with a few quick tips for appeals and hearings. Okay, let's start with a history lesson. In 1935 was the Great Depression, in 1929, the U.S. financial institutions collapsed and many companies laid off workers. And this caused the unemployment rate to skyrocket to over 20% nationwide. And it was actually this event that prompted our government to find a means to provide relief to these impacted individuals. So on August 14, 1935, President Roosevelt signed the Social Security Act, which contained provisions for elderly insurance, welfare, and unemployment insurance. Now, the U.S. unemployment program is federally mandated. However, the individual states are free to administer the program as they wish, so as long as they meet 4 of the federal requirements. So the first federal requirement is the replacement of lost wages. So the main objective here is to protect workers from a temporary loss of wages. So while the weekly benefit amount that someone can collect will vary from state to state, unemployment is always only meant to replace a portion of a worker's earnings. So for example, if a worker makes $1,000 a week while they're employed and they get laid off, they're not going to receive $1,000 a week in unemployment. And this is in part to provide an incentive to that unemployed worker to return to work. It's generally about 50 to 60% of their normal weekly wages while they were working, up to whatever the cap is in that particular state. The second federal requirement the states have to meet is stabilization of national employment. And so this objective actually creates an incentive to the employer to retain their workforce by taxing them or charging them on their prior unemployment experience. So if an employer has a high level of chargeable claims against their account, their tax rate is going to be much higher than a company with little unemployment activity. Now, this is slightly different for nonprofit companies that are exempt from the taxes, but the principle is the same, right? There is a financial impact to an employer for not retaining their workforce. The third requirement is stabilization of national economy. And the objective here is to help retain some of the consumer purchasing power, thus preventing an economic downturn. So in other words, if a person has no money coming into their household, they will likely not have any money going out of their household. They're not going to be spending any money in the economy. And this could lead to a cycle and an overall economic downturn. So the goal of unemployment benefits is to help prevent that. The fourth and final federal requirement is job placement. And this is why the state unemployment agencies are the primary job placement bureaus in America. So outside of these 4 federal requirements, each state administers their own program within these 4 guidelines established by federal law. This is why the regulations regarding like eligibility, benefit amounts, length of time someone can collect is going to vary by state. However, when it comes to eligibility, there are 5 criteria that are actually consistent in every state. In order to be eligible to collect unemployment benefits, you must be able to work, so physically able to perform some type of work. You can't be disabled. You must be available to work. So you can't be drawing benefits while you're on a, 2-week vacation in Europe. You have to be available to work. You have to be actively seeking work. You have to meet the state's monetary requirements, and there's, a historical component there as well as a, current component if you're maybe working part-time currently. And then you have to be unemployed through no fault of your own. So the no fault of your own is very subjective, right? Highly subjective. And we are going to talk a lot more about that when we get to the different types of separations. So believe it or not, the unemployment system really hadn't changed much since 1935. That was until President Obama passed the Trade Adjustment Assistance Extension Act of 2011. And this was major legislation that resulted in new regulations to promote unemployment insurance integrity. These regulations, which went into effect in 2014, changed the way that employers need to view their role in this process. Previously, employers made a choice between responding or not responding to unemployment claims, and they would often respond only if they wished to contest the claim. But moving forward, employers are actually legally required to respond to all claims in order to remain in compliance with these new regulations and avoid potential financial penalties. These new regulations basically stipulated that the state unemployment agencies had to prohibit relieving employers of charges to their unemployment account when both of the following conditions exist. So if the unemployment benefits were improperly paid due to the employer's failure to respond timely and adequately to the state's request for information, or the employer has established a pattern of failing to respond timely or adequately. So when we talk about the term adequate, like what is an adequate response? And we're going to get a lot more into that again when we talk about the types of separations and documentation. But in general, you need to make sure you're responding to every question that is asked of you by the state agency, and you need to provide all of the details of that final incident. And if you're claiming that there was misconduct, you're going to need to provide some supporting documentation. So those are just sort of the general rules around what would be considered an adequate response. And then when we talk about timeliness, the deadlines can and do vary by state as well as by form type. So the states actually dictate those deadlines. And on average, they usually allow somewhere between, honestly, it can range anywhere from like 4 to 10 days to respond with the adequate information. And, failure to do so would sort of put you on that naughty list, if you will, or be considered an event of not responding timely or adequately. And there's a couple states that actually, even before all of this went into effect, have some financial penalties associated with that. So, for example, in the state of Vermont, every time you fail to respond timely with the details on a claim, you get a $100 fine. And in Maryland, it's like a $15 fine. So there's some states that were sort of ahead of the game on this and have always had penalties related to not responding timely. Now, the third piece is a pattern, right? Employers who have established a pattern of doing this. So what is considered a pattern? It varies, again, by state as everything does, but in general, it's usually 2 or more instances of failing to respond timely and adequately, or 2% of your total claims in the prior year that you, again, failed to meet those compliance standards. Now, what happens once you sort of have established this pattern and are on that, naughty list, so to speak. Basically, what it says is that you must be prohibited from getting relief of charges, especially when this occurs is usually like if maybe the claim was originally approved and the person started collecting and maybe you appealed it and it gets overturned at that hearing level. Historically, before 2014, you would get all that money back. It was owed to you. But now, basically, the states are saying, look, if you're at fault, employer, meaning you didn't provide all of the details we needed to make a good decision initially, you're not going to get any of that money back. We cannot relieve you of charges because you are not in compliance with our laws and regulations. Now, this legislation might seem harsh, but if you think about it, the intent behind it is actually beneficial to all parties. It's going to reduce inaccurate payments, which is it's going to result in better initial decisions, which is going to be less hearings for you to have to attend. So it's not going to take up as much of your time. It's going to help keep the states from becoming insolvent. So, I mean, if you think about it like this, right? If the employer doesn't provide all of the details and documentation that they should have at the initial claim, okay, and the state awards this person benefits, they've probably collected hundreds, if not thousands of dollars by the time it gets to an unemployment hearing, okay? So if you then bring all that necessary details and documents to the hearing and you get it overturned, the state now has to go and try to get all that money back from a person who's not working, okay? So how are you going to collect hundreds and thousands of dollars from an unemployed individual? Now, I can tell you that in most states, especially if you're a nonprofit, you're not going to get that. Even if you're not on the naughty list and you're supposed to get the money back, you're not going to get it back until the state gets it back, okay? So, I mean, there's a few states that give it back to you right away, but most of them don't. And I've seen it take up to 5 to 7 years. So if you think about it, it really is in your best interest to make the effort to provide all of those details and documents at that initial claim level so that you're getting the most accurate and appropriate decisions up front. It doesn't mean you're never going to have to appeal something, but it certainly will reduce efforts around that. Okay, so let's talk about some financing of unemployment. I cannot stress enough that unemployment benefits are 100% funded by employers, either through taxes or through direct reimbursement. It is not uncommon for individuals to believe incorrectly that they pay into unemployment out of like their payroll taxes or something. And a lot of people think that this is like a benefit or an entitlement that they're owed. This is not the case. There are 3 states that do require a small employee contribution that they might see on their paycheck. Those states are New Jersey, Pennsylvania, and Alaska, but it's a very small amount. And what you should know is that those taxes that they're being taxed go directly to the state for the cost of administering that state program. It does not go into funding the benefits. Okay, so the benefits are 100% financed by the employer. So when it comes to funding the unemployment benefits, there are 2 types of employers. There are merit-rated employers, also known as those tax-paying employers, and then you've got reimbursing employers, or also known as self-funded or self-insured. So a merit-rated employer could be a for-profit company or a nonprofit company. And if you are currently a merit-rated employer, you are going to be issued a tax rate each year in every state that you operate in. And then you're going to have to apply that rate to your state's designated wage base. And that's going to determine your taxes. So I'll use a state example of Oregon. So in 2024, the Oregon taxable wage base is $52,800, and your rate could go as high as like 5.4%. But let's just say your rate in 2024 that you get is 4%. That means you're going to pay 4% on the first $52,800 that every employee earns. So that would be $2,112 per employee. So let's say you've got 100 employees that earn that. That's going to be $211,212 $200 that you're going to pay to the state in taxes every single year, regardless of whether you had any unemployment claims or not. So that's how that tax system works. In addition, most states are going to use a 3 to 5 year look back period to determine an employer's tax rate. So if you have one bad year, that could affect your rate for several years after. There are also a lot of socialized costs that are built into that rate. So you might not have had any claims at all. You might have done everything you were supposed to do. But if the economy at large is having some difficulties, or they, just a lot of claims in general in that pool, your rate is going to go up regardless of anything that you did there. So there's really two pieces of that. And one of them is somewhat controllable and the other one is not controllable at all. So the other type of employer is going to be a reimbursing or a self-funded. In order to be eligible to be a reimbursing employer, you have to either be a nonprofit organization, a government agency, or a tribal organization. And so these types of employers have the ability to opt out of that state tax system and reimburse the state just for the benefits they use, dollar for dollar, right? So this can be particularly advantageous for several reasons, right? You're only going to pay for the actual benefit payments that are issued and what you actually use. So you're not going to have any of that economic socialized costs that are going to be affecting you. So think about it like this, right? During the pandemic, it was really scary for reimbursers at first because, they have to self-fund all those benefits. But thankfully, right, the federal government stepped in, gave them some CARES Act relief, which helped offset that. And ever since the pandemic has ended, we have been at historical all-time lows for unemployment charges. And so those reimbursing employers now are reaping the benefits of only paying for what they're using, and they're not using a whole lot, whereas all the tax-paying employers right now are seeing massive hikes because they have to refund the system at a higher rate than what they utilized. So like, for example, that Oregon example I just gave you, in 2023, the taxable wage base was, $50,900. And I think the years before that, it was even lower than that. It keeps going up, right? So it went from 50,900 up to 52,800. And so your taxes are just automatically going to go up no matter what, because they've got to refund that system. So being a reimbursing employer can really be advantageous. It's not right for everybody. It depends on how much turnover you have versus what your taxable payroll is in that state, as long as your taxable wage base is in those states. So, if you're currently on this call and you are paying taxes or something still, and you want to be evaluated for that, we can help you figure out, if reimbursing is the right option for you. So I really do find it very interesting that most studies that attempt to quantify the cost of turnover usually use some sort of variation of turnover cost equals the cost of hiring plus the cost of training the new employee. But very rarely do they ever consider an unemployment claim in that turnover cost, and they should, because it is a very real cost and it does directly impact your bottom line. Okay, it's only somewhat controllable, but you should be controlling those expenses where you can. So I like to show this chart just to illustrate how much one unemployment claim can cost you. So let's use Washington in this example. The maximum weekly unemployment benefit in that state right now is $999. So if someone were to collect that for the full 26 weeks, one claim is going to cost you nearly $26,000. Okay, nearly $26,000 for one unemployment claim. So it absolutely impacts you, and it impacts your bottom line. And so that's why we really recommend that you pay attention to your claims and that you really manage those costs where you can. So let's talk about chargeability and liability, because some of the most common questions we hear in this industry are, why am I responsible for this claim? And how much am I going to have to pay for this? So let's talk through how the state figures that out. So let's look at this chart over here in the orange box. the very first thing that the state is going to do when someone files a claim, and this is in every state, they are going to determine something called the base period. And in almost every state, the base period is going to be the first 4 of the last 5 completed quarters. Now, there are 2 exceptions to this because they just have to be different. Massachusetts and Minnesota use the last 4 completed quarters, but most states are going to use the first 4 of the last 5 completed quarters. So how we would look at this chart is those unshaded boxes on the far right that have the arrows pointing to them. That would be the filing quarter. So the quarter in which the claimant goes to the state and files a claim. And then looking to the left, the shaded boxes are going to be what that base period is. So right now we're in the month of February. And so that's that top right unshaded box, right? This is not a completed quarter. We are still in an active quarter. So it's the first 4 of the last 5 completed quarters. So if you look to the left, you will see last quarter is that white box that has nothing. And then the shaded gray to the left of that is going to be your base period. So right now, if someone files, the base period is going to be from October of 2022 through September of 2023. Okay, so this is why someone who left your organization a year ago, you might get a claim for or might be chargeable for that claim. This is why. So that white box, that's sort of that 5th quarter, we call that the lag quarter. And so you're probably thinking like, why? That's weird. Why do they do that? There's actually a very good reason for this. At the end of each quarter, employers have usually about 30 days to file their quarterly wage reports with the state. And so if we don't have the wages, the state can't determine what they need to determine. And so they use that lag quarter to allow time for employers to get those reports in. So states like Massachusetts and Minnesota, it's really annoying because if someone files right away in a new quarter and the states don't have your reports yet, they're going to send you this manual wage questionnaire that you have to fill out, and it's really a pain. So the lag quarter really does make sense. But think about it, right? So like if somebody left your company, maybe they left in December of 2022, and they go file a claim today in February 2024, you're still going to have 3 months of wages, in that base period. So you are going to be, in most states, in the proportional states, you're going to be a potentially chargeable employer. So that's important to keep in mind, the base period. What does the base period do? What is the purpose of it? So the 4 things that the base period does is A, it's going to tell the state whether or not the claimant has worked enough to meet the minimum wage requirements to qualify. It's also going to tell the state that if the claimant's eligible, how much they're going to be eligible to collect and for how many weeks they'll be able to collect. It's going to also tell the state which employers are potentially chargeable, and it's going to tell them, these are the employers we need to send a base period claim to. And then it's also going to tell them if the claimant's found eligible for benefits, how much is each employer responsible for paying. So let's walk through a specific example. So this graphic that we have here is another illustration of the base period. So you can see here, you've got the red arrow is going to be the claim filed. So let's just pretend that's February of 2024, right? That lag period is going to be, last quarter. It's going to be Q4 of 2023. So then you've got your grayed out base period back here, which is going to be October of 2022, right through September of 2023. So you can see from looking at this that there are 3 companies involved in this claim. You've got Company A, Company B, and Company C. Now, Company A is going to be both a last employer and a base period employer. So what that means is Company A was the last employer before this person went and filed a claim. So whatever reason they separated from this most recent company, Company A, that is going to determine this person's eligibility. So they are the last employer. Only one last employer claim is issued. Company B is going to be a base period employer only, and Company C is going to be a base period employer only. So company A, they're going to get that last employer claim, which is going to be used to determine eligibility. And they're also going to get a base period notice because they have wages in that base period. And so they have some sort of financial liability. So the base period notice is going to address financial liability. Now, in a proportional state, which is the example we're using, if you are a last employer, but you didn't have wages, maybe they haven't worked for you for very long and you don't have wages in that base period, you might get a last employer claim to help the state determine eligibility. But if you don't get a base period claim, in most states, you're not actually chargeable. So you're not actually even going to get hit for any of the benefits. Now, companies B and C are only going to get a base period notice letting them know that they have some financial liability if the claimant is found eligible from, based on their reason for separation from their most recent employer. Now, I do want to talk about base period employers for just a moment. It's different for tax-paying employers versus self-insured employers for very good reasons, okay? So for a tax-paying employer, we talked about all those socialized costs that you're paying. So you're paying all kinds of money into the system, and some of that is socialized and pooled, right? So if someone leaves your organization a year ago and they don't file a claim, but maybe you fired them for misconduct, but they quit, both things that might be disqualifying if they had filed a claim, but they didn't file a claim. Maybe they went and found another job, and now a year later they're filing because they got laid off. Well, the state is not going to penalize this person for getting fired a year ago. That's not what prompted them to file the claim. They're filing because they were legitimately laid off from their most recent employer. And so the state's going to pay them if they're laid off, right? Regardless. But when it comes to charging, if you're a tax-paying employer and they left for misconduct or they quit, you actually can protest the base period financial liability saying, don't charge this against our unemployment experience because, we fired this person for misconduct or they quit. If you are a nonprofit self-insured, in most states, there's exceptions, I'll get to those in a minute, most of the time you cannot protest those. And that's because you only self-fund dollar for dollar. You haven't paid anything into that socialized pool. So how are they going to pay this person who's legitimately owed benefits if they don't have any money in that pool? So that's why nonprofit employers who are self-funded typically don't get to protest unless they're the last employer. So just some explanation there on why you might get charged even if you fired the person for misconduct and they waited a year, to file, and they filed for qualifying reasons. Now, in this particular example, the wages that were reported by these three employers, the total wages in the base period was $50,000. So if the claimant is found eligible, their weekly benefit amount's probably going to be somewhere in the ballpark of $480 a week. So again, 36 of the 50 states charge proportionately based on the wages that each employer paid in that base period. So in this particular example, company A paid $5,000 of the $50,000 or 10%. And so they're going to be responsible for 10% of those benefits or $48 per week. Company B, in this example, paid $20,000 or 40% of that $50,000. And so they're going to be responsible for 40% of the weekly benefit amount or $192 per week. And then company C, similarly, $25,000 or 50%. So they'll be responsible for 50% of the benefits. So that's how the state, proportional states will do that. Now, a couple of other state examples would be like Illinois. They're going to charge the last 30-day employer if they also have wages in the base period. So like company A here, if company A was in Illinois, this company A would be responsible for 100% of the benefits because they charge the last 30-day employer that also has wages in the base period 100%. If company A did not have wages in the base period, they would charge company A 50%, and then they would go back and charge the other base period employers the other 50%. So it's kind of interesting how they do that. And then states like Iowa and Massachusetts, they do inverse chronological order. So they would take that 480 and they would start paying the claimant 480, and they would start with company A until they exhaust company A's liability. So company A was only responsible for $48 per week times 26 weeks. That's $1,248. So they're going to pay probably 2.5 weeks of this person's benefits, and then they're going to move on to company B, and so on. As long as the person is still collecting until they exhaust, each employer's liability, they're going to move backwards. So those are really the three main examples of how states charge. But again, the majority do proportionate charging. The next two slides, I have them in here just so that when you download the presentation and you have, I'm not going to cover these, but these two go through some of the state exceptions for nonprofits that self-fund when it comes to base period claims. So some states do allow you to protest those, even though you didn't pay into that socialized fund. So like Iowa and Colorado, you can protest as a nonprofit all base period claims. Whereas like, Pennsylvania, they have this interesting thing called a solvency fee. So every year they're going to issue you a notice that says, hey, if you pay this particular fee, this one-time fee, you have now essentially bought the right to protest base period claims. Now, those base period claims still have to be for disqualifying reasons like misconduct or acquit. Doesn't mean you can protest layoffs that were in the base period, but it does allow you to have the right to protest some of those claims because you've essentially paid a one-time fee into a socialized pool, if that makes sense. So if you are a nonprofit self-insured employer, when you download the presentation, feel free to look through these two slides to see if you're maybe in a state that's got some of those provisions. All right. Next up, we're going to talk about the different types of separations that can occur and what type of documentation you should be collecting to support these separations. The time to win an unemployment claim is not when you receive it. Once that person separates from your employment, it is too late. You can't go back and create the necessary documentation and the personnel file that you're going to need to win the claim. It's too late to get that resignation letter. It's too late to do those coachings and written warnings. And so this part of the presentation is really going to focus on best practices and how to win that claim before it's ever filed. Now, unemployment is not black and white, okay? It is extremely gray. Two things that might seem exactly the same, two scenarios, one detail could shift it one way or another. So again, we're just going to try to help you understand the shift and how the state looks at the different facts, how they apply it to the law, what might be, considered misconduct versus not misconduct, so that you have a good understanding of what type of details you should be providing, what type of cases are worth pursuing maybe to a hearing and which ones aren't. So let's jump into that. So there are three types of job separations that are going to be recognized in unemployment adjudication. And every separation is going to be put into one of these three buckets, if you will. So once the state determines which one it's in, which bucket it's in, then that's going to dictate the flow of how that claim is adjudicated and who has the burden of proof on the claim. And the state is going to determine which bucket that separation falls into by looking at factors such as who was the moving party that initiated the separation. They're going to look at things like, was continuing work available? So, for example, like discharges, right? We all know that if you fire someone for a violation of a policy or gross misconduct or something, that's going to be a discharge. I mean, we all know that. But there are other separations that are going to be adjudicated like a discharge. Suspension. If you suspend someone and you haven't actually fired them yet and they go file a claim, it's going to be adjudicated like a suspension because you as the employer are the moving party. You separated that person from their employment. This person was not allowed to work during this time. And so it's going to be adjudicated with the burden of proof like a discharge would be adjudicated. Same with a mutual agreement. You can mutually agree to part ways all you want. You can call it a quit all you want. But if you were going to fire them anyway, if they didn't voluntarily quit, then it's not a quit. It's a discharge, because continuing work would not have been available had this person not chosen to quit. So that's how they're going to lump those into a discharge category. So then voluntary, right? Resignations, no call, no shows, they just stop showing up forever. We know that those are voluntary. But leave of absences, those are going to be adjudicated as a voluntary quit, even though this person hasn't actually quit, but that person has voluntarily separated themselves from employment, and therefore they are going to be the moving party, and it will fall under the rules of adjudicating voluntary quits. And last up is lack of work. So lack of work is a pretty broad category, actually. You've got your obvious stuff like reductions in force and layoffs and things of that nature, furloughs, all kind of the same thing there. But what you might not realize is temporary work, seasonal work. When that person separates from a temporary job, a seasonal job, it doesn't matter that they came on knowing it was going to end. It's a lack of work, okay? Reduced hours. If you reduce someone's hours below a certain threshold, it's a lack of work. If this person is working part-time and their hours fluctuate and it falls below a certain threshold, it's a lack of work. So there's a lot of things that go into lack of work, but we'll talk more about that when we get to lack of work. So let's dive into the different types. First, we're going to talk about discharges, okay? And as I mentioned, very, very great area here. With a discharge scenario, the state is going to put the burden of proof on the employer. They are going to have to prove that the employee was discharged for misconduct. What you need to understand is that it's perfectly possible for you to have followed all your policies correctly and to have discharged someone for cause, and it might not meet the state's definition of misconduct. The state generally defines misconduct as a deliberate or willful disregard of an employer's interests or repeated violation of a known policy. Okay, so what I want to do is I want to walk through some of the more complicated discharge scenarios that are generally not going to be considered misconduct, so you can kind of understand what the state is looking for there. So the first one we're going to talk about is an isolated incident. Okay, if an individual is terminated for a policy violation but didn't have any prior warnings for a similar infraction, the state will typically rule it as an isolated incident of poor judgment. So this often comes up when employers have a progressive discipline policy and the claimant's violations were what we know or what we call a mixed bag, meaning they weren't for related things. So maybe you had given this person a verbal warning for their dress code. Maybe they got a written warning for attendance and then a final warning for attendance, but then maybe the final incident that resulted in the termination was a violation of the social media policy. Well, unless it was gross misconduct and could stand on its own, the state is generally going to want to see at least one prior warning for a similar infraction. The state wants to know that this person knew that their actions could result in their immediate termination. And so since they had never been warned for the social media policy before, the state could reasonably argue that this person didn't realize that when they made this mistake or this error, poor judgment, that it was going to result in their termination. Some states are stricter about this than others, but you know, at the end of the day, you've got to follow your policies, and most employers do have like a 3 strikes and then the 4th strike if you're out kind of a policy. If they happen within a certain time frame, that's okay. Again, they're not saying you did anything legally wrong or that you shouldn't have discharged them. You might have made a very good, solid business decision, but it might not be misconduct, okay? So the second one we'll talk about, which is very similar to the first one, is what we would call a good faith error. The difference here, so again, no prior warnings for the same thing, but maybe the error they made while it was against company policy, maybe they thought they were doing what was in the best interest of the company. They weren't intentionally trying to harm the employer. So I'm going to give you a real example that I saw in my times when I was handling claims for a very large retailer that we all are familiar with. As a very large retailer, they are very susceptible to lawsuits, right? They have a lot of liability there and risk. And so they have a policy that basically states that their loss prevention employees are not allowed to pursue individuals once they have reached the parking lot. So essentially, if they are no longer in the building or on the front sidewalk and they have stepped off into the parking lot, they are not allowed to approach them. For whatever reason, this is what they've decided is not acceptable. And there was a loss prevention individual who, was newer to the job, had never had any prior warnings, was watching a suspect, knew for certain that they had merchandise on their person, and in the heat of the moment, the passion for doing a good job, made an error in judgment at the last moment to approach this person. They couldn't get to him in time. They were in the parking lot, and they made the decision to approach them. The employer, per their policy, they have a zero tolerance because of the liability and discrimination risk and things of that nature. So they had to fire this person. The state's going to say, look, yes, they violated your policy, but they were trying to do their job. They thought they were doing a good job. They made a bad decision. They'd never done it before. The state's generally going to call that a good faith error. There are a lot of examples of good faith error in jobs today that you could apply to this, but just know that if the person was doing what they thought in their mind would benefit the company and not hurt the company, and they just made a poor choice, not going to be misconduct, most likely. The next one, and this one's super, super frustrating, is attendance. Okay, so generally attendance, and this again is going to vary by state. Some states are really a lot better about this than others, but in general, attendance is going to come down to the final reason, the final absence that caused you to terminate them. And if it was deemed beyond their control and they followed your proper attendance policy of reporting it, a lot of times it's not going to be misconduct, okay? So, for example, it doesn't matter if they had like 100 absences. If the final absence that caused you to terminate them, say, was for illness and they were sick and they properly reported it per your policy, a lot of times the state is going to say, doesn't matter how many other absences they had and what they were for, they can't help it if they're sick. If they're sick, they're sick. They can't come to work. Now, some states, to take some of the ambiguity out of there, they say, if you have a point system and it's a no-fault point system, they'll take that and it's okay. It doesn't matter if it was for attendance. They'll allow benefits. So it really just kind of depends on your particular state. So what I would say with attendance is always provide all of the details, the documents, and the policy, and let the state apply it to the law and make a determination, okay? If the decision comes back and none of the facts are in dispute and the state says, well, we get it, but it's not misconduct, I would not recommend appealing it further, okay? So supply all the info, wait and see what comes back. Don't appeal it any further. Now, if the facts are in dispute, because remember, there's two sides to every story here, and the state has to make a decision based on both people's stories, the claimant and the employer. If the facts are in dispute and you feel there was misconduct, then that's when you would appeal it, okay? But if they say, yes, we recognize they had 1 million absences, yes, we recognize the final absence was illness, we recognize they properly reported it, it's not misconduct, and that aligns with what really happened, you're not going to change their mind. That's the law. What are you going to take to them to tell them that being sick and reporting it properly is now misconduct? You're not going to be able to do that. There are other caveats to this, right? So if there's a policy violation on the final incident, then you can focus on that. So maybe the person didn't properly report it. Maybe they were sick, but they waited. Maybe your policy says you must report it at least 30 minutes prior to your shift, and you must talk to your direct manager, right, on the phone or whatever the rule is. And maybe they didn't notify y'all till 30 minutes after the shift started, Or maybe they just texted a coworker and said, hey, can you let Bob know I can't make it in today? Those would be policy violations, and that would be different. So now you can now explain to the state, look, we had a policy. Yes, I get that they were sick, but they didn't follow the policy. Maybe they no-called, no-shows on that final incident, but then tried to come back to work later. Like they didn't abandon the job, but they also didn't report it. Maybe they overslept and they were late. And that was the final incident. The state often rules that oversleeping is within your control, and then you could win that. Maybe you have, two people that are dating and they work for you and they just always happen to be sick on the exact same days. Or maybe they always happen to be sick the day after payday. If you can find a pattern, that's another way to approach attendance. So I would say, the key to attendance is making sure you're documenting the reasons for the absences, because it does matter. Always follow your policy. Sometimes we think that allowing extra chances is a good thing. The state actually looks at that very negatively because they're going to say, well, if you're not uniformly enforcing your own policies, how are people supposed to know what is expected of them? So I would say, make sure you're following your policy to the letter, and at the end of the day, provide all the details. If the facts align, there's really not much you can do about it. It just depends on your state and how they look at that. The other one is poor performance. This one is another frustrating one, and it gets a slide all of its own. So one of the more, I would say, controversial reasons for separation and more frustrating is one that surrounds a worker who is discharged due to poor performance issues. So an easy way to think about this when it comes to unemployment is wouldn't versus couldn't. So the worker wouldn't do the job or they couldn't do the job, okay? So the state feels that it is an employer's responsibility to hire the right and most qualified people for the job. So if you make a bad hiring decision and you hire someone who is not qualified to do the job and it doesn't work out and you've got to let them go because they've never been able to perform up to your standards, the state is not going to hold the employee responsible for your bad hiring decision, and they will be allowed benefits, okay? Here's the deal. If someone is, okay, let me back up. Employers often use this separation reason as sort of a generalization, sort of an overarching reason that they put into their personnel files. It kind of is an all-encompassing, hey, it was poor performance, let them go. When really there could have been some underlying misconduct there. There could have been some policy violations. Here's the deal. The state is not going to look at your HRIS system. They don't care how you code it. Maybe you only have 4 codes that you can use, and poor performance was the right one. It comes down to the details. So here's what I would say. If you think there was misconduct, do not respond to the claim with the words poor performance. You would want to either focus on a policy violation, or you would want to display how this person previously met our standards, thus proving they can do the job. Maybe supply a former performance evaluation that says, Bob's been here a year now, and he meets the standards of the job, meets or exceeds standards, whatever, he's doing a great job. Then all of a sudden, Bob starts messing around and he's not doing the job. Well, that could be considered, misconduct-related performance, because you can prove that Bob can do the job. If the duties haven't changed, his responsibilities haven't changed, like he wasn't promoted or something like that, and all of a sudden he's not performing for whatever reason, you can win those. Again, don't call it poor performance. Like, the state sees that word and they close their mind and they open the checkbook. So again, it doesn't matter how you code it in your system. Reflect the appropriate details accordingly so that the state can make a good decision on that. I want to give you some examples of a separation and the difference of when it might be considered misconduct on the same separation reason versus when it might be considered inability or poor performance, okay? So let's say you hire an employee and part of their job responsibilities include driving a company-issued vehicle. Maybe you have a policy that states a certain number of vehicle accidents is going to result in termination. Well, I can tell you it doesn't matter how many car accidents this person might have. You can never prove that someone purposefully had a car accident, right? They're just not a good driver. That's why they call it an accident. You hired somebody to drive a car and they're just not a good driver. Now, on the flip side, if that person was texting while driving, maybe they took some cough syrup that morning and they got real sleepy and fell asleep at the wheel, something like that, or any other policy violation, well, now you have misconduct, and you should not focus on their lack of driving skills. You should focus on the policy violation that caused the accident, okay? This person was texting and driving. This caused the vehicle accident. This is misconduct. They know that they're not, per our policy, allowed to text and drive, right? That is how you would approach that. Another thing that I want to talk about is those key terms. When I said the state closes their mind, opens the checkbook. So this is a real example. I once worked with an employer that had a call center. And so the employees that work in the call center, there's a policy called call avoidance. And if they find that you're deliberately avoiding incoming calls, because that's your entire job as a call center employee, you're going to be terminated for call avoidance. Well, this claimant was initially denied benefits. The employer won. They had provided the details, the documentation, they won the claim. The claimant appealed it and it went to a hearing. And what happened was the employer, it said when we got the hearing decision back, it said by the employer's own admission, the claimant's, quote, mistake was staying away from the phone too long. And because they used the word mistake, it went from they were deliberately avoiding incoming calls and not doing their job to oopsie poopsie, I stayed away from the phone too long. I made a mistake, right? So that's why you want to be very careful about the terminology you use and how you present the separation. If you feel that the person is not capable of performing the job and you hired them, I'm not going to tell you how to run your business, but recommendation from an unemployment standpoint would be to separate that employee as soon as you realize this. We talked about that base period. We talked about chargeability. So you are going to drastically reduce your liability if you separate that person quickly. You might not even be a chargeable employer yet. The person's going to be able to collect benefits because they were unable to perform the job. So you don't have to worry about feeling guilty about that. And then you'll be able to more quickly fulfill that position with someone who might be able to perform the job. So again, best practice would be don't try to make it work. Don't force it. If it's not a good fit, separate them as quickly as you're able per your company policies and then, move on. And just know you're probably going to you could pay unemployment benefits if they've been with you long enough to maybe have some liability in that base period. Usually if you do it within the first 90 days or 120 days, you're going to have very low liability. It depends on your state and how they do the charging. So let's talk about what kind of documentation, what is effective documentation for you to win claims or to have the burden of proof to prove misconduct. So first of all, you're going to need the dates of employment. That's every separation, okay? First day of work, last day physically worked, you're going to need those. But outside of that, for a discharge, you're going to need the details of the final incident, okay? What happened that was like the straw that broke the camel's back? And what triggered you to say, okay, we are now going to separate this employee? This is not a 10-paragraph dissertation about everything the employee ever did since they worked for you. That will actually work against you and confuse the state. Don't do that. Details of the final incident only. Bob did this on this day. Here's what happened. Do not use general statements like Bob was terminated for insubordination. Not good enough, okay? The state is going to want to know what you consider to be insubordination. What did Bob do? What did Bob say that was insubordinate? How did you respond as the employer? That's all going into the details of the final incident, right? Then they're going to want to see okay, what policy did this person violate on that final incident? So they're going to want to see a copy of your policy so that they can make sure you as the employer followed your policy and that the employee in fact did break it, right? Then you're going to need the employee's acknowledgement of the policies, because if the employee says, well, I didn't even know that was a policy, you've got to prove and show that this person was made aware of policies at the time of hire. So that could be a handbook acknowledgement. Maybe they took a test online. Any way that you can show they were provided those policies. Now is your opportunity with prior corrective action or warnings to show the history, right? Again, we start with the final incident. We start with the policy violated on the final incident. Then we move on to leading up to the final incident, what led to this point, okay? So this is your opportunity now to provide those prior warnings, corrective actions that will show that this person should have known that termination was imminent, unless, of course, it's gross misconduct, which is super rare. But in the cases of like theft or employee violence, you do not have to have prior warnings. Just give the details, you know, that sort of thing. Now, witness statements, very important here. Anything that you submit on an unemployment case is going to be public record to the claimant. So if there is a sensitive situation at hand and you are worried about potential retaliation, do not submit witness statements. Even though they could help you win the claim, they could be like the smoking gun that really gets it done. It's not worth it if it causes this employee, this former employee, to, maybe they're a violent person and maybe they retaliate against whoever wrote these witness statements. So if you are worried about that, please do not submit the witness statements. Again, it is not worth it, and know that the claimant will see those statements. All right, let's talk about voluntary quits. This is a much easier topic. When someone voluntarily separates from your organization, the burden, and they file a claim, the burden of proof is going to be on them, and they're going to have to prove that they quit with good cause attributable to the employer. They're also going to have to show that they took all reasonable measures to try to preserve their employment before making the decision to quit, okay? So what would be considered good cause? Like, what might the state say, well, that's good cause attributable to the employer? Well, if you change the condition of their employment, so let's say you hired them to be a bookkeeper, and now you're like, yeah, we're short a receptionist, and we're going to need you to also be our receptionist on Thursdays and Tuesdays and Thursdays. And this person is, you know, maybe they're an introvert and they like being a bookkeeper, and that's what they were hired to do, and they're very uncomfortable. Maybe being on the phone gives them anxiety, and you're now changing the condition of their employment. If you're going to force them to be a receptionist and they have no other alternative but to quit, the state's going to say, well, you changed the condition of their employment. They had every right to leave because you left them no choice, okay? Also, if someone's being harassed or there's a hostile work environment and you as the employer don't take appropriate action. So the key there is that the former employee had to have reported it to you and allowed you time to resolve the situation. They can't just quit and then go to the state and say, well, I was being harassed or this was a hostile work environment, but yet they never brought it to HR or their manager and they never allowed you time to address it. The state's going to say no go. And they're also not going to expect you as the employer to always be able to resolve these to someone's satisfaction. So really, you're just going to have to show in this kind of a scenario that you took proper action, you made reasonable accommodations to make this employee feel comfortable and safe. They opted to quit anyway, right? So that's kind of where this comes in. On your standard quit, it's pretty easy. You know, you're just going to say why they quit, dates of employment, they left, right? But if they start making some sort of accusations, such as harassment, hostile work environment, those sort of things, or if you know ahead of time, they're probably going to use that. Make sure that you've got all of the details and the documents surrounding that sort of contentious departure so that you're able to combat that, you know? And then also, continued employment must be available. I mentioned this earlier, okay? If you allow someone to quit, or it's sort of what we would call a forced resignation or a mutual agreement, it's a discharge. It is not a voluntary quit. Again, state does not care what you put in your HR system. They're not going to go look at it and say, well, this doesn't match. They care about the details. They don't care about your codes. So if this person wasn't working out because they're not a good fit, or whatever, and you guys say, I'm going to let you voluntarily resign versus like discharging you so that you don't have a discharge on your employment record, you can do that totally fine. Just know that when it comes time for the unemployment claim, if that person files, you are going to have to approach this as a discharge. So if this person had some sort of misconduct or a policy violation, you would want to provide the details as if it were a discharge. So what kind of details do you need for a quit? As I mentioned, most of them are really easy. So dates of employment, reason provided by employee. I would say best practice, get a written letter of resignation or get them to put something in writing. Like if it's just a text message, an email, anything, it doesn't have to be like a formal letter, just something, because what happens a lot of times is that the person might tell you as the employer one reason why they're quitting. And when they go to file unemployment, they change their story. So if you can have something in writing, that's going to be really helpful. You're going to have notes of like how they reported it to you. So did they call? Did they write a letter? Did they email? Did they just stop showing it? Like what happened? Who did they talk to? Did they give notice? Did you allow them to work out their notice? If you don't allow them to work out their notice, doesn't mean they're going to be able to collect forever, but they'll definitely be able to collect during the notice period that you did not let them work. So that is also critical detail to have in your file. Exit interviews are great. If someone's leaving on good terms, or even if they're leaving because they're upset about something, if you can do an exit interview to really capture the full scenario and have an opportunity to address some of these things, that is going to be very, very, very helpful. And again, if there was some sort of contentious issue, dissatisfaction, potential, harassment issues, make sure that you have documented that and what actions you took, any investigations, potential resolutions, that sort of thing. So it can get complicated on a voluntary quit, but in general, it's going to be much easier. But as always, there are weird state rules and exceptions that can be very frustrating. So just know that there are some voluntary quits that you're going to have to pay unemployment for, even if it wasn't attributable to you. So some examples of that would be like most states have a domestic violence clause. So if someone had to voluntarily quit to leave the area because they were being abused or something that was a dangerous situation in their home, the state is going to consider that to be a compelling personal need. And even though you as the employer are not at fault, they're going to consider them eligible for benefits a lot of times in that scenario. You could imagine why, right? They're still going to have to meet all those other criteria. They're still going to have to be actively looking for new work. They're going to have to be available for work. So once they get settled at their new place, that's when they might be eligible to start collecting. If they're in hiding somewhere and they're not available for work, they're not going to collect, right? So there are some other things that come into play there. It's not just the reason for separation. Another example would be a lot of times, if not every state, but a lot of states, if somebody quit to move with a spouse that was taking a better paying job, as long as that person is looking for new work, they've asked for transfers, maybe they asked for remote work, as long as they've taken all reasonable measures to try to preserve their employment with you, the state's not going to penalize somebody for moving with a spouse. They're not going to break up spouses. And if the spouse is leaving for a better job that would benefit their family, a lot of times the state is going to allow them to collect for a period of time once they are, available, and if they're looking for new work, and that they've exhausted all reasonable options to try to retain work with the current employer. Again, these are just some of the provisions. Just know that they're out there. It's really about you providing the details and letting the state apply it to the applicable law. All right, so let's talk about lack of work. Lack of work is the entire intent, right, of unemployment. I mean, that's kind of why this got started. And, people get separated at no fault of their own. they're going to be eligible. The normal ones that we know about or that we think about are, the job eliminations, reduction in forces, that sort of thing. But again, we talked a little bit earlier about those seasonal workers, summer programs, that kind of thing. If you hire a temporary employee, the reason why the state considers that to be a lack of work is they're not going to discourage an individual from accepting temporary work just because that work is going to end at some point. If when that work ends, they're still looking for work, they're still actively seeking work, but no work is available, they are going to be eligible for unemployment. The state's not going to say, nah, you took a seasonal job, your fault, you're bad, you're now not going to be eligible to collect unemployment. No, they want you to take work, whether temporary or not temporary. So it's not a penalty for taking temporary work. If you were a retail organization and you hire Christmas help, after the Christmas season is over, if that person's still looking for work and doesn't have any work, they're going to be eligible for unemployment. And then, part-time workers, we're going to spend a little bit of time on here. Part-time is a little frustrating because it's tricky too. So the state has like 3 categories. They categorize part-time work in 3 different ways. You've got regular part-time employees, which is defined as someone who works less than full-time hours, but has the same schedule every week, okay? So if they work Monday, Wednesday, Friday, 9 to noon, that's their schedule pretty much every week, they are going to be considered regular part-time. In most cases, they're not going to be eligible for benefits. You can usually protest regular part-time because you hired them for regular part-time. There's no fluctuation. Nothing has changed. Now, part-time works all available hours. This is defined as someone who works less than full-time hours, but their hours vary week to week and fluctuate based upon business needs. If this individual is putting no restrictions on their hours and they're accepting all available work that you are offering them, the state is typically going to rule that as, lack of work. And then they're going to start looking at, well, how much are you earning each week? Where does that compare to what you normally earn in the base period? And they're going to define whether you're underemployed that week or not, okay? And the key there is whether or not the employer is dictating those hour fluctuations, right? Or if the employee is, and whether or not they're making themselves available, again, accepting all work. So then on-call is kind of similar, meaning, they work less than full-time, or they might work full-time weeks, but maybe their work is on and off. Maybe they have no set schedule. They just work as needed, maybe on an assignment basis, and they're not refusing work, right? If they're working all available hours offered to them, again, the state is going to usually consider that to fall into a lack of work. Now, just because it's a lack of work, you have to remember there's 4 other criteria that the person has to be meeting. So it doesn't necessarily mean that they're going to qualify. It just means it's a lack of work. And so they are considered unemployed at no fault of their own. And then they're going to look at some of these other factors, right? So let's talk about protesting regular part-time, okay? Some strategies here. When it comes to protesting lack of work, you really can't unless there is a protestable issue. So you can protest regular part-time in most states and say that nothing's changed, or you can protest availability issues. So what I mean by that is, let's say you've got a regular part-time person and they work a set schedule, just provide that information to the state. You should be usually good in most scenarios because their wages aren't changing and their hours aren't fluctuating. Typically why people file when they're working part-time is usually has nothing to do with you as the employer. It usually has to do with they work for you part-time, but maybe they have another employer. So when they file the claim, they're not filing it against you. They're just filing a claim because they lost some work. But you are in the base period, and so you are going to get a claim. So the best way to alleviate those issues, honestly, if it's not regular part-time and they're working all available hours, is to offer them more work. Because what the state's going to do is they're going to look at, okay, well, how much is this person earning? Is it at or below what they would be earning in unemployment? And if it is, then they're going to get a partial benefit and you're going to be charged your share. And the only way you can really avoid that is by offering them more hours. So if you see a claim come through and you've got a part-time employee that is working all available hours, offer them more hours, right? Because here's what's going to happen. Either they're going to accept those hours and they're going to be earning too much and not be eligible each week to collect because their pay is going to go over that threshold. Remember, it's usually about 50% of what they were normally making. So if you can up their wages, you'll be fine. You're not going to pay anything. And then you've got, you're getting more work out of them. Now, if you offer them more hours and they refuse, well, now you can report that to the state and say, well, this person has an availability issue and they're not available for work. So remember, it is a lack of work, but now they're not meeting the other criteria of being available for work because they're not accepting all work. So if you report that refusal, a lot of times then the state will go back to the claimant and ask them why they're refusing work. If they're not considered available, they're going to usually get disqualified for a certain period of time. So again, can't really protest lack of work, but you can protest regular part-time and you can protest availability issues. If you're going to protest an availability issue, just make sure you take note and provide to the state of whether they're accepting all the hours, document any refusals, what was offered. It has to be similar work, right? Similar pay. You can't offer them a totally different job that they've never done before that pays $3 less an hour than the one they're making now. The state wouldn't consider that a bona fide offer, right? So document what you're offering them, why they refused it. And here's a tip. If you are an employer that has people that are on call or casual or work assignments as needed, so this could be substitute teachers, this could be in-home care workers, any sort of job like that, use your unemployment report, like who's filed for unemployment recently, and use that as a recall roster. Same with maybe some of those seasonal temporary workers. You could do the same thing. If you have work available, reach out to those people first because, their claim is probably legitimate at the time they filed. But if you have work, offer them the work. Reach out to them. Document what you offered them. If they take the work, well, now they've been hired and they're not going to collect unemployment against you. Or if they refuse the work, again, you can report the job refusal and, or assignment refusal, same thing. It works the same. So like for a temporary employee, maybe you offer them another assignment or another job, and that would be a job refusal. For a substitute or an in-home care worker, maybe they refused an assignment. You can protest those availability issues and say, whatever. Or again, maybe you get them back to work and you're fulfilling your needs as a business and you're keeping them off of unemployment. This is what staffing agencies do. I can tell you staffing agencies have a huge unemployment liability. So what they do is, every week when they get their, they see their list of people who have filed a claim the previous week, when they have jobs come up, those are the first people that they're going to reach out to and offer work. All right. There is sort of a special nuance with summer camp employees that I want to call out. So if you are an employer that does a summer camp, there are some states that will exempt the camp staff from unemployment coverage. So you have to meet the certain criteria. Number one, the employee has to be a full-time student, employed less than 13 weeks, and the camp has to operate for less than 7 months a year. Not every state does this. I've listed the ones that I'm aware of, and I believe these are the majority, if not all of them. If you're in one of these states, you should not be reporting these individuals' wages on your quarterly wage reports to the state. If you do, this person will be eligible based on lack of work. So we talked earlier, temporary employee, they get separated. if they're still seeking work and none is available, they're going to be able to collect. But if they don't have any wages for your organization, any qualifying wages there, they're not going to be able to collect against you. And these states that I've listed do not consider these wages to be subject to unemployment. So if you're hiring full-time students that are just working in the summer, whether that's like a high school student, a college student, whatever, and it meets these other two criteria and you're in one of these states, make sure you're not having your payroll company report these to the state on your quarterly reports. They should be excluded as they are not subject. They're not deemed as wages for purposes of unemployment. Another strategy about lack of work claims. Understand the rules of severance for your specific state. It does vary. How severance is paid can make a difference. So some states, it doesn't matter how it's paid. You're going to get unemployment still on top of the severance. Some states say, well, if you pay them a lump sum, we're only going to disqualify them for the week in which they get the lump sum payment, and then they're going to be eligible. And other states say, well, if you allocate it out, like biweekly, like how they would normally be paid, then they'll be disqualified. And some say, yeah, it doesn't matter how it's paid. We're just going to disqualify them. We'll take the lump sum payment and we'll allocate it out of what it would have represented, right? So it just depends on your state. So when you're developing your severance packages, know your state's rules and apply them accordingly in how you want to manage your expense, right? A lot of times severance is to help in place of unemployment benefits. Some employers want them to be able to get both, but it just depends on the state, and how you pay it can make a difference depending on what your goals and objectives are. Also, know if your state does not consider severance to be wages. So similar to these summer camp employees, certain states do not consider, and I know California is one of them, severance payments are not subject wages. Do not report them on your quarterly reports, because what can happen is someone could be collecting, because like the state of California doesn't disqualify you from unemployment if you get severance. So you can get severance and you can get unemployment. Well, then what if their claim expires? So a claim is usually good for 1 year from the date that they file or until they hit their maximum. Well, what if that year goes by, that claim is over, they open a new claim? Well, now there's a new base period. And maybe you wouldn't have been in the base period had you not reported the severance wages, but those separating pay, you reported it, and that happens to fall into that base period. Well, now you're going to pay unemployment on separation payments, and you're going to be reliable for unemployment. I've actually seen this happen in real life to a California employer who did not know this rule, and so they had to go back and amend all of their prior payroll reports. So know in your state, because your payroll company, they're not always going to know. They really aren't very good at catching these kinds of things. So know if they are subject wages or not subject wages to unemployment. And don't report them if they're not subject. Last but not least, consider using reemployment services to reduce liability. So if you're a member of our organization, if you're a member of the 501c Agencies Trust, reemployment services are included in your membership. So if you have to lay some people off, you can offer them these reemployment packages at no additional cost to you. And not only does it help smooth the transition for that separated employee, but it also gets them back to work faster and thus reducing what you're going to pay in unemployment, right? These are all strategies. We're all talking about how to reduce your costs and how to manage these claims. Not every claim is contestable. Not every claim is winnable. Some things just fall into the law, but there are lots of things that you can do as an employer to control some of these costs. All right, so now I'm going to go just through some very quick tips for appeals and hearings, and then we will go through any questions that we have time for. So here's the thing about hearings, okay? Firsthand testimony is crucial. You are very unlikely to win if the firsthand witness is not present. Now, it doesn't mean you can't still do a hearing. Maybe that supervisor no longer works for you. It's okay. You can still appeal it, but just know that there's going to be more weight given to the claimant's testimony because they are there as a firsthand person giving their testimony. If you just send the HR person that wasn't directly involved in the separation, you know, or you send your company attorney or somebody who wasn't even there, it's going to get less weight in the testimony. So it's really best you can send multiple witnesses. Always include the firsthand witness if they are available and able to participate. The other thing about unemployment hearings is to try your best to remain calm. So it's not uncommon, I should say, for these things to get a little emotional or a little heated, because sometimes, not always, but the claimant could be on there making totally false statements. They could be saying things that are 100% untrue. Do not get worked up about it. Try to stay calm. Rebut any statements that they say are false. Don't interrupt them, okay? You know, in a discharge situation, the employer is going to go first. And in a voluntary quit situation, the claimant is going to go first because it's about who has the burden there. So if you already had your turn and then the claimant's now going and they say a bunch of things that are not true, make a note so that you don't forget. And then you will get an opportunity afterward to rebut those statements. Do not interrupt them, okay? Don't get worked up. Again, try to address only the facts. So when you're explaining the final incident, as I mentioned, don't muddle up the scenario. Like, don't go through this whole story about everything this person's ever done since they worked for you. Only focus on the final incident, what policy they violated, how they were made aware of the policy. Then you can say, and on this occasion and this occasion, they were warned about this. They were told that if they did this again, their job would be in jeopardy. So that's when you can talk about prior instances. And also, things that happened after your decision to terminate really are not relevant, as disturbing as they might be. So like if you bring someone in to terminate them, you've already decided they had, they violated a policy and you brought them in to terminate them. And then they get upset and maybe they throw a chair across the room and break a lamp. Don't even bring it up. I mean, I guess you could, but I'm telling you, it's not going to matter. Certainly don't consider that in the final incident because it's not what made you decide to terminate them. You already decided to terminate them before that ever happened. The other thing is you want to make sure, because there is so much back and forth, offer a closing statement so that you can summarize. Basically, after all the back and forth and all the rebuttals, you will get an opportunity to sort of make your final statement. That's where you can go through and just net it out. Here's what they did, here's what they violated, and here's why. Just be very methodical about it. And the other thing is, again, if you're a member of our organization, we offer hearing representation, which is someone that attends the hearing with you. They prep you for the hearing, and then they attend. They handle all the documentation and the files and exhibits, and then they attend with you. They cannot attend for you because, again, you really got to have that first-hand testimony, but they're there to help you. Maybe they do your closing statement. Whatever you guys agree on during the prep session, I would say that, you guys can decide who's best to do that, but definitely give a closing statement. And just remember that this is a very informal process. Most hearings are very informal. Simply, they're just going to ask you some questions, and they're going to go back and forth between the employer and the claimant, and then you're going to summarize. So don't be intimidated. They are informal. And in most states, what happens in an unemployment hearing is not relevant in post, like if somebody files a lawsuit against you and you have to go to court or something, most of the time, there's like 5 states that what happens in the unemployment hearing is going to be material fact in further pending lawsuits. but that's only 5 states. In most states, what happens at an unemployment hearing is not relevant in further legal proceedings. So I would just say no if you're in one of those 5 states. It's called collateral estoppel. So notice or pay attention if you're in one of those states because you might proceed differently when it comes to the unemployment hearing. It might change your decision on whether to participate. So, just another thing to keep in mind. All right, so that's amazing. I finished with 5 minutes to go through questions. I almost never get done that quickly. So I'm going to check the questions box. And again, if there are questions I did not get to, as I stated earlier, I will follow up with you directly. I want to be respectful of everybody's time. And so if there are questions I don't get to, I will certainly reach out to you directly via email. All right. So it looks like, we do have a few questions. Okay. So the first one is, can you tell me the difference between request for relief of charges and appealing a claim? Okay, so they are the same, right? They are the same. What I would say is if you're appealing the claim, you are requesting relief of charges, but you're requesting it from the go forward date of the hearing or for the whole claim. So what I mean by that, I don't mean to be confusing, but earlier we talked about those employers that might get on the naughty list and they might not get relief of charges for between the initial claim and the hearing. But they can get relief going forward from the date of the hearing forward. So if you're not on the naughty list, you can get full relief all the way back to the initial date of the claim. Whereas if you are on that naughty list, you might only get relief from the date of the hearing forward. So you are appealing in an effort to seek relief of charges, if that makes sense. Let's see. If you have it in writing on the final warning that any further infractions of any kind could result in a discharge, will that cover the employer? No, not necessarily. Most of the time, in most states, they are going to want to see a prior warning if it's not gross misconduct. It could even just be a verbal. This is why it's so important to make notes in your personnel file. Even if you just talked to the employee one day very informally about something, make a note of it because that could be the one that saves you. It's really going to depend on how egregious and how related sort of these infractions are. Like I said, it is very gray. Here's what I would say. Absolutely put that statement in there if it's true. If any infraction of any kind could result in discharge, put it in there, but just know that the facts, and depending on your specific scenario, they could still consider it isolated incident of poor judgment. It's just going to depend on the other facts within the case. But it is always going to help you and never hurt you, if that makes sense, to put that statement in there. Okay, so we terminated an employee due to not providing company policy while out on suspension. He ended up getting benefits because the unemployment division focused on the suspension issues and not the refusal to return policy. He would not have been terminated after suspension had he would have. So, that's an interesting one. So typically the way suspensions go is most of the time they're going to be out, like if they file while they're suspended, they're often going to be eligible to collect during the suspension. And then you as the employer, you're not going to get a new claim saying that the circumstances have changed. So it's going to be up to you to proactively let the state know, okay, now this person has separated and here's why, okay? So they may very well be eligible to collect during the suspension because you haven't actually proven misconduct at that point. But oftentimes, if you can either A, prove misconduct was there, then a lot of times they'll go back then and disqualify them for the suspension as well as going forward. Or if they were fired for a different reason because you said that they wouldn't have been terminated had they followed the return to work policy. So that would be separate. Then they might be allowed then to collect for the suspension period, but they should have been disqualified going forward. Now, I don't know what happened in your specific scenario, but going forward, if that ever happens again, you do have to proactively update the state on the change in scenario. So it sounds like, and I don't know if this happened at the initial level or maybe if this was at the hearing level, but it will be up to you. Most times the claimant isn't going to tell the state that their scenario has changed, and so it's not going to trigger a new claim for you to respond to. So you can't wait till an appeal or a hearing to then say, well, this is what happened. They would have come back. You actually need to provide that proactively once they've been separated. And I know that that's kind of a pain. Here's what I will say. If you are a member of our services and you utilize our claims platform, there's a link there to provide like subsequent claim info, or you can message your consultant and they'll provide it to the state for you. But you definitely need to proactively update the state on those changes. And again, and I also want to state on that, it depends on what the issue's at. If it was at a hearing or whatever, it's going to depend on which issue they're adjudicating. So the suspension issue, again, should be a separate issue from the discharge issue. So you have to read the language that they put in there because they'll tell you what they're addressing at the time. And so you need to make sure that you, again, let them know that there's a separate issue at that point and that it has changed. And then they should lump that into two separate categories. Company self, okay. Hello, will this webinar be shown again? I missed the first hour. Yes, I do this webinar every quarter. I do it every quarter. And we also have recordings. If you need to get a recording, my email address is nkorn@501c.com. So that's nkorn@501c.com. Email me. I will get you a recording. Or if you would prefer to attend it live again, wait for the invites to go out next quarter, and you can attend again. Okay, so let's see what time it is. Okay, well, we're 2 minutes past time. So any of the other questions I didn't get to, I will contact you via email directly. Again, if you're looking for those continuing education credits, wait for the survey that we send you. Once you fill that out, give us about 24 hours or so, and we will send you the code for those SHRM or HCRI credits. That's how you get those. So fill out the survey, you'll get the credits. Thanks for spending some time with me. Again, there's a copy of the presentation in the handout section. So if you haven't done that yet, go ahead and download a copy. And yeah, I hope you learned something new today, and look forward to my email if you answered it, or if you asked a question that I haven't answered yet. All right, and with that, I'm going to end today's webinar. Have a great rest of your day.